What do you find when you're maybe doing these typical types of presentations that the appetite would be for self-storage as a passive investment versus something a little bit more active or traditional like residential real estate?
Actually, quite good. Self-storage has become a known product and the advantages of it. It is the safest asset class for an investor to be in because it has the lowest foreclosure rate of any asset class out there. During COVID, the first couple months, nobody knew it was going down. Everything was shut down. But by the end of the second quarter, that first year of COVID, our occupancy rates went way up, and so did everybody else's. COVID created demand for self-storage. It's not recession-proof, but it's sure recession-resistant.
I'm Garrett Wong, and this is the Investing to Win podcast. How do you define success, and what does winning look like for you? Mark, welcome to my podcast.
Hey, Garrett, real excited to be here, man.
Yeah, me too. Me too. We're talking in the green room that you're one of the few people that actually listen to my other episodes. No, I'm just joking.
You got a great podcast. You're a great interviewer, and you got a wide variety of people on there, so I'm real excited to be here.
Yeah, and I am too. I often it's when the podcast started a couple years ago, it was all about real estate investing and the traction was really, really good. And then it kind of started progressing as podcasts do into origin stories because I really like meeting people and hearing the entrepreneurial journey. But why I'm excited today is because you're actually talking about an asset class that I've been really, really curious about. So, but before we do that, I don't want to be a spoiler. Why don't you tell the audience a little bit about yourself?
Well, thank you. My name is Mark Helm. I'm sitting in Louisville, Kentucky. That's where I'm from. And I got in the self-storage business in the mid-90s, and we've had storage all over the Southeast and Southwest, as far as Texas. And I woke up most of my life like a real estate agent. I got in the real estate business in 1985. That's when I lost all visible means of support. Got in the real estate business, and I haven't had a W-9 income since then. And in 1995, one of the designations we have, and you have them there in Canada, is the CCIM designation. And I got my CCIM designation in 1995, and it's really strange. Within about 2 weeks after getting that designation, I got a call from Vin Reet, who used the CCIM Rolodex to find me sitting in my office in Louisville, Kentucky. And that acquisition director asked me if I could help him find self storage. And of course, if you ask a real estate agent, can you help me find real estate? There's usually only one answer, and that answer was yes. And at the time, I was, wore coat and tie, commercial real estate agent. I was real focused on office. I'd sold a lot of office buildings. We managed office buildings, and that was kind of the world I trafficked in. And I thought about self storage as a simple little dumb business, but if this guy wants me to help him find it, we'll go looking. And it did not take me long working with this guy to see what self storage really was. As a real estate agent, how I related to it was it's like a warehouse building. You got a concrete floor and a steel wall. And at least in my market, a concrete wall and a concrete floor and a steel wall were generating, let's say, 350 a square foot for the warehouse portion and maybe $8 or $9 for the office portion of it. And I was seeing this guy buying this stuff at it was generating $10 a foot, $12 a foot income, and there was no capital improvements, no sinks to replace, no carpets to replace, and it did not take me long to realize that, man, this is an asset class that a guy like me should be in. I was managing office buildings, and it was nothing for us to set a dumpster out in the alleyway, run a chute out a window, and throw out all of the tenant improvements that we had made just 5, 6 years ago to to rebuild that space so we could rent it out. If we were renewing a lease, we used to budget back then 550 a square foot just to renew the lease with commissions, and you had none of that in storage. And I really fell in love with it. Now, I made good money as a broker, but I also lived somewhat deal to deal. I had expensive lifestyle, and I just didn't have a big net worth. So I tried to figure out how can a guy like me get in that business back then. And the one skill set I had is I could find deals. So basically, I would find deals, put them under contract, then syndicate them and bring investors in. And that's how I got in the self storage business. And it changed my life. And so today I'm still in the self storage business, albeit on a much smaller level, but I also coach and support and consult and have training to help other small investors get into business.
Wow, that is just a breadth of experience. A lot of my listeners know that I had a brief foray into being a realtor. Always had an interest in commercial real estate, but I think it kind of depends what your flavor is going to be. Speak to me a little bit more about let's define self-storage for the audience. I think it's kind of obvious, but why don't you just kind of let's just like break it down right to its roots.
Well, a little bit of the quote history of self storage. There's a debate going on whether it actually started in Texas or started in Florida, but it started in the 40s. But a lot of people with wealth would and still do. I know a lot of people who will go out and buy land in the path of progress. And when you own land in the path of progress, you basically got to cut the grass and or pay the taxes on it. And storage started as a way to generate income on land in the path of progress. And it was, pretty simple concept. And what happened was that as in the late 50s, early 60s, as path of progress was approaching, people realized they were getting better returns on the storage than they could on the shopping center or the apartment complex they were going to build. So, the first publicly traded company to be in that space was Public Storage, and I can remember in the late '60s, my father, had bought some stock in that company and was trying to tell me about it. I was in high school, and I thought, "Man, that sounds like a dumb business to be in." But, Public Storage is the largest, publicly traded REIT still in the space. So, when I first worked with that acquisition director in the '90s, he told me that the only kind of, really innovation in the past 20 years has been climate control space. That's absolutely not the case today. This space is evolving very quickly. But what we usually mean when we say storage is it's self storage as opposed to warehousing. So in self storage, you have a unit or a space that's defined as yours. You move your stuff in and out, and you pay a it's not we call it rent, but legally, at least in the US, legally, it's not rent. These are customers, and they're paying a monthly fee for space. And I don't have a lease with them, although we call it a lease. I have a contract with them, and what they're storing is chattel. So, as a warehouseman, if somebody gets behind on paying, I don't evict them like you would with a landlord tenant relationship. I enforce my lien rights on their chattel. At least in the US, that's the legal kind of difference between storage and most other types of commercial real estate.
Okay. And then when we're talking about self-storage, I'm thinking about these little, you know, I guess there's side by side units with a roll up door, different sizes. Is that
Yeah,
what we're
yes,
talking about?
exactly, exactly. Now you can have multi-story self-storage, but mostly you have, drive up, single story self-storage. You would pour let's say, a 9,000 square foot concrete pad, and you get a system fabricated, and you've got various sizes, and it's roll-up doors, and we use fabricated storage systems.
And then overhead wise, I mean, do you need somebody on site 24/7 to be able to say, okay, you're allowed to go down this row, or is it truly just self access?
Usually it's self-access. Now, you may or may not have a manager. A lot depends. I work with people. If I was working with you, for example, I would find out kind of what your goals are, why you want to be in the business, long term, short term, what your strengths and weaknesses are. And for example, my business model, not that it's the model, there's a lot that are probably better than mine, but my business model was I would buy mom and pop facilities, let's say 20, 30,000 square feet that I could expand on and add more space. And I would do that and create a 50,000 or more square foot facility. Why? Because that's what REITs want. And I wanted to develop a product that an institutional buyer would buy. In from nine, I mean, from 2012 to 2019, we basically built up 2 brands. One was more suburban single story, and then we had an urban brand, and we ended up selling both of those in 2019, 2020. But our model was we would have something that the institutional buyers would look at. So in our model, we had managers in place. So our operating expenses on average ran with a full service, 50,000 square feet or more. You need that kind of income for having employees there typically. And we would run our operating expenses at 36, 38% to 42%. Now, a lot of people I work with, and I myself now have involved in one, what we call automated facilities, which means there's no manager on site. Typically today, those are smaller, uh, 40,000 square feet or less. And there, the customer just uses a kiosk or their phone to move themselves in. You can pay rent on your phone. Um, or your computer. Sometimes we have a kiosk there as well. Now, it doesn't mean there's no people involved, but there's no manager on site. So they move themselves in, but we have what we call boots on the ground. We have a guy that has a route in a pickup truck, etc. And they're there a couple times a week, inspecting it, cleaning it up, getting units ready, locking over people, etc. But those are kind of the 2 basic models today that people can choose from.
Did I hear you say 30 to 40% operating expenses?
30 is so if I'm doing a full service with managers in place now, we kinda I don't wanna say we overpaid our managers, they probably don't agree, but
Oh, maybe they're listening, maybe they're not.
we offer health insurance, for example.
Yeah.
Most people in our
Okay.
industry don't. I have 401ks in place for them. So we had
Wow.
kind of high quality managers that because in my world, running so storage is like building the shopping center, then opening the store inside the center. So we trained our managers on how to sell. Our key performance indicators were based around sales and occupancy and retail sales and tenant insurance sales. So we trained our people well. We wanted to keep them, and we were looking for more than just somebody to be there. We wanted salespeople. We ran it higher than the industry average, but we were running 38 to 42%. Now, if I'm running an automated facility, we can run those down in the 31, 32, maybe 33% of my expense ratio. And those are operating expenses.
But doesn't that mean on the flip side, your margins are like 50, 60%, or am I missing something there? Because
60% or more.
that's huge. Like it's
Well,
crazy.
and what's great about it, if you think about it, just high level view, again, it's a steel wall, concrete floor, costs a heck of a lot less to build a storage facility than it does an apartment building, but we're getting, in some markets, more. I usually wanna be less, but we're getting dang close to what apartment rents are in almost every market. So for that's they kind of go tangent together. So if you think about it, I've got steel wall and concrete floor generating apartment type rents. And I don't have the ongoing capital expenses that you have with apartments or any other
Oh,
asset class.
sure.
That's why it's a good facility. I mean, good asset class. And what happened was in 2008, it did so well compared to everything else. I think we averaged in the US an average drop of 8%. Now, that means our occupancy went down 8%, but compared to retail, compared to office in that 2008 recession, it did dang well. And that's when it caught the eye of Wall Street. And when the recovery came, that's when all the money started pouring into self-storage.
Well, I mean, I just had a thought in my head here. I mean, in the crash of 2007, 2008, when people are basically giving back their keys, you would almost think that the self-storage facilities would their profits would increase, their occupancy would increase because now people, unless they just gave away their whole house full of belongings, but they have to store that somewhere intermediate or while they're transitioning back from home ownership into rentals. Do you think there was a trend in that direction in those
Well,
years?
oh, yes. So our occupancy went down because people who weren't like relocating or being forced out of their homes were cutting back on discretionary spending. We lost,
Okay.
on an average, some. But the typical customer, when I say typical, what I call residential customer, um, storage tends to be a necessity they have when there's changes in their life: death, divorce, moving, promotions, recession. So both recessions and boom times create changes. So storage is in demand. Now, during the recession, um, our occupancy went down and we had to work harder on collections. But overall, my occupancy went down, but it wasn't like devastating at all. Compared, I went out in the real estate business, I went 16 months without a commission. There was no lending going on, but yet I was in the storage business, so I was making money. And during COVID, the first couple months, when everybody, nobody knew it was going down, everything was shut down. Our occupancy went down a little bit, but by the end of the second quarter, that first year of COVID, our occupancy rates went way up, and so did everybody else's. COVID created demand for self storage. So it's not recession proof, but it's sure recession resistant. The challenge today is you've got to be real careful where you put it because so much storage has come on the market in many markets and trade areas. So you just got to be careful where you put it. You do not want to, as a small investor, you do not want to go into an overbuilt market. And there's easy ways to determine that.
So if you're in an overbuilt market or you're in a market, but then a big player comes in, how do you compete other than on price?
Well, a lot of ways, but a lot depends on where you are in your lease up. So if you're a stabilized facility, in other words, on average, today we're stabilizing out at about 88 to 90% economic occupancy. Sometimes less, but usually today 88 to 90. That's what I would underwrite if I'm looking at a deal. That's how I would underwrite it. So what what you do if you're stabilized, you handle that a lot differently. So, for example, I had a project in kind of a gentrified area of downtown Louisville, and we were stabilized, and I was getting 1780 a foot income, gross income on my occupied units. My 10 by 10 was $149. I had a extra space open up in our same market. They were offering $70 for a 10 by 10, first 3 months free. So That was my competition. So, I'm stabilized. I would do something very different if I was in lease up, but my decision was not to race to the bottom. What we did was we gave our manager the leeway to go up to 1 month's rent free, and we didn't lower our rates. And what happened is, as you can guess, our occupancy went we were at like 97%. We went from 97% down all the way down to about 85%. We function very well at 85%. It's just my monthly distributions to all my partners went down a little bit. And then once Extra Space went through their initial lease up phase, their rates started going up. And um, when I sold that project a few years ago, I was uh, over like 155 for a 10 by 10. So that's how I handled that one. If I'm in lease up, I do things very differently. I typically will, I don't want to say mirror them, but we will use lower price points on the initial going in rate, and then we raise them 3 months, 6 months, 9 months to try to get our in-house, price points up to where we want them to be. But I'll do things very differently in a lease-up situation than I will if I'm stabilized. But that's how you compete. You compete on price, you compete on move-in specials. If my 5 by 5s or if I have more 5 by 5s than I wanna have, I'll run a special just on those units. Very often, I would give people a truck to use to move in, and if somebody was in another storage unit and I'm in lease up, even though it's, quote, "self-storage," hell, I'd rent a truck and go move them in. I'd hire a crew and go move them from one facility to into my facility if that's what it took during lease up. But, you gotta be careful. And when we're underwriting them, we factor that in. If we're gonna be doing lease up, I throw in concessions during year 1 or 2. And where a lot of the opportunities are today, though, are not it for us, are not in the bigger Atlanta or Chicago or those type markets. We're going to the smaller markets, either outside the big MSAs or even smaller towns and cities where there's much fewer of the bigger institutional players. And that's where we're finding a lot of the opportunities today.
So, you're drawing a lot of parallels. You're talking about terms that I love: syndication, underwriting. I mean, I'm in the multifamily asset class quite a bit when we're throwing around those. Can you sort of explain what a typical deal might look like? And I'll preface this by first saying, on just generally speaking, on a syndication for an apartment block for a multifamily, you might have a model where there's sort of a joint venture and you get your partners in. There's a lift or a rehab of that apartment block. There's then a refi, and your JV partners get some or most or all of their money back. And then they're in it for the long haul to split the cash flow. And then the other popular model is you get a pool of money together. Um, in and above the, emergency and reserve funds to purchase the asset, hopefully at less than, 99 cents on a dollar type of thing. And then you're holding it, waiting for the asset to increase in value, let's say 3 to 5 years. And then the general partners choose when to sell that. And then everybody gets their cash on cash return. Can you kind of explain some general models or maybe some of the ones that you find more successful for self storage?
Yeah, and as you know, no one knows better than you, Garrett, that there's infinite ways to cut that pie, and I've seen all kinds of models, and they're the average investor today is a lot more sophisticated and knowledgeable than they were 10 years ago because they've looked at a lot more deals, and the syndication industry has evolved quite a bit. So, I think 15, I wrote a book. And in this book, I talked a little bit about my how we were doing it. So I'm gonna give you 2 models I like. When I got going, my goal was to use other people's money to build a portfolio, and then, um, I would take the risk during the while we do the value add play, and then there would be a, liquidity event where they got their money back, and then they could stay in the deal. That was kinda my goal, and, I was a not a known quantity, I was just like Mark, a guy, and, part of the reason I wrote that book was to create some, validity that I knew what I was doing, but, still, I wanted to create investor-friendly relationships. So, I looked at how other people who got going, and I actually modeled off Texas Roadhouse, who, I talked to the attorney who helped Texas Roadhouse restaurants grow, and what we did was, in our model, we had an LLC for each asset, and everybody, investors and what we would call sponsors, were all common members. So we didn't have 2 classes. We had, but the investors had preferred rights while their money was in the deal. So while their money was invested in the deal, they got they owned 70% of the LLC shares, and the quote sponsors had 30%. And we could not put, for example, it took unanimous consent to put more loans on it. It took unanimous consent to sell it. They were really protected. I couldn't dilute their interest. And what I would do is I would take their money, their 25% or 30% equity, buy the deal, expand the deal or whatever I was doing, convert the building, and then get it up and stabilized. That generally took 3 to 5 years on our project, still does. And once I had done that and got to stabilization and ran it stabilized for 6 months to a year, then we would refinance it. The investors would get their money back. Any unpaid preferred return, so they got preferred return. If I couldn't pay it, it accrued, accumulated. So any unpaid preferred return, they would get their initial money back. Then it flipped. I was 70% owner, or my group. They were all their money back, all their preferred, but they were still in the deal owning 30% of it. They got 30% of the ongoing cash flow, and they got 30% of the upside when we sold it. That's one model that I used very successfully for 10 years or so. Today, mostly what I see out there are 50-50 investor sponsors. Investors put the money in, just like my old model. It was me, my group were the ones on the loan. We're the ones on the loans. Investors put their money in. They get a preferred return. Today, it's usually 8%, 7, 8% is what I'm seeing out there. And there may or may not be a liquidity event in 5 years, but typically they're in the deal for the life cycle of the deal. And today, most investors want to see the life cycle 5 years, and then we either buy them out or we sell the asset and pay them off. And they have a preferred return during that time. That's usually what I'm saying. And then if we hit certain thresholds, for example, when we're liquidating the asset, once they get, let's say, a 17% internal rate of return, then our split as sponsors goes up on the remaining portion. We might get 80% of the remaining and they get 30. So there's a infinite number of ways to carve that pie, but that's typically how we're doing it.
I'm shaking my head here for those who are listening on Spotify and Apple, and I'm shaking my head because I think I'm just blown away by the asset class, the fact that you just don't know what you don't know, and I'm continually humbled by people like yourself, Mark, who are such experts in the industry because, like, not to say that you're talking over my head, but you're just you've really figured things out. Um,
Well,
Speak to me
I've
a little
made
bit.
every mistake you can make, Garrett. I've made
I
every
was just
mistake you
gonna
can make.
ask you, okay? You're stealing my thunder here. I wanna know about the mistakes, right? Because it's easy to talk about these successes, but you can't have success without failure. So, tell me a little bit about the early days, the trial and error, maybe some of the really bad mistakes if you're allowed to talk about them, just so that we can learn from you?
Well, first quote, well, I've made a lot of them. I still do. I have never done a deal, never, that I wouldn't do something different in that deal. So, like in my, it's, I know a lot about storage, but like nothing's handled. I learned on every deal, I learned something. The game is you just don't want what you do to be a killer mistake. When I first got going and when I bought my first facility, I closed on it December 31st, 1999, syndicated that deal. But so I first got going way back in the day, and I was organized a lot differently in my syndications. And everybody who's in the self storage business knows this. I didn't know it. But what happens is you get unsolicited offers all the time. And I was getting unsolicited offers 3 and 4. I'd built a small portfolio of 3 properties, and we were getting offers on our projects 3 years into it that I had projected on a 10-year cash flow. This thing, were above what I had projected they'd be in 10 years. And, I was, so the way I was organized is my investors said sell, we sold. So I was out of the business as quick as I was in the business in my first run at it. So I addressed that in my second run. Um, so I've made I made a lot of investor mistakes. Like one of my skill sets is I'm not necessarily the best communicator with investors. I learned the hard way you cannot over communicate with investors. So I brought team members in now to over communicate with investors. I tended to baby my investors a lot, which is not necessarily a good thing. Um, so I've learned that whole world, how to navigate with investors and having the right attorney in place and having the right LLC documents in place. Um, I've also learned, somebody you would think I would know not to get emotionally involved in deals, but I've gotten emotionally involved in deals and I've done deals I shouldn't have done. Uh, I've um, I I've never, with one exception, I don't think I've ever lost investors have never lost their money. We had one project where the investors got real scared. I told them, "No, we need to pivot. We need to where we were gonna put our expansion, we need to put some parking there for now. I'm gonna need X number of dollars, much less than what the expansion was gonna be, but we need X number of dollars to do the parking." They got freaked out, wouldn't do it. So basically, I deeded them the land free and clear. That was their way of, they gave them that for their equity. Then I went on and did what I was going to do on the balance of the land, and I sold the project and made a profit, but they own that land free and clear. Other than that, I've missed a few times on performas, but in other words, I generated less return than I said I would, but nobody has lost money. But I bought that facility. It was at the end of a cul-de-sac next to an expressway. The sign ordinances had changed. I couldn't put the sign up that I wanted. I did not do that due diligence prior to closing on the land, and that was a big mistake I made. And then I make a lot of so how that affected me is less people would buy my product when it came time to sell, and it slowed the lease up. So I've made a lot of mistakes in the meantime, but none of them were as big as those.
Yeah, well, let's back up for a second there. If you can kind of expand on the part where you had to the deal where you had to deed the land. Like, why did you have to not expand? Was that just because the expectation you didn't think that you're going to get to the occupancy? You didn't want to spend good money after bad money, or what?
They just got scared, and rather than enforce some of the documents, see, these investors have been in a lot of deals with me and made good money on a lot of the deals, but they just got scared on this deal.
Why?
Um,
What made them scared though?
well, here another mistake I'd made. So I just got excited about this deal. Guy approached me to do the he owned the land and wanted to do this deal, and I did it and brought some other investors in. The problem with it is, was at the end of a cul-de-sac, and it was in a demographic area. Today, I like to be, if I'm in a market, I don't have to be in the upper end of the market, but wherever the median is, I wanna be there or above. In this particular one, I was there or below, less than the average household income in our market. And what that means is, and I didn't realize this, I should have known this, but I didn't think it through. What that means is that these people have less disposable income and their stay in the unit is a shorter time period. So one of the things I look at is my average value of a customer, like how long, what's the average length of stay, and what's my average rent. And I come up with a value for each lease that tells me how much I can spend on marketing. So here, people's stay was average was 11 months. So during a lease up period, I would have to rent that same unit 2 or 3 times to get to stabilization. Whereas if I was in another part of my market, I would have only rented it once, maybe twice, but there was a lot more churn here. So it took longer for the lease up. So I had whatever, 24 months of interest only. So I had my loan starting to amortize. I wasn't near where I thought I'd be on the lease up. And so we had to bounce, we had to pivot, we had to, and I'm, as a real estate person, you pivot a lot in life, For an passive investor, it was freaking them out. So rather than have them take that ride, I gave them an asset worth at the market rate of what they what their money was.
Sure. And putting the parking lot there instead of building out more units, what would that have done? Is
It
that just to
generates income. It does. It's nowhere.
Okay.
It's like land in the path of progress. So
Yeah.
if I'm getting, I think in that project I was averaging 10, 50, $11 a square foot for non-climate control. Well, I was getting $5 a foot for parking, but
Sure.
it generated some income while I went through the longer lease up process on what I already had built. And then once that got stabilized, then we would do the expansion. And what I did was, once that stabilized, I was able to sell the asset with the parking in place that they could do the expansion and get the upside. But I had what I'd already, the first phase of it already stabilized. And so we got out of that project and we had a really good asset on the other side of town. And we made this a must take with that asset. And we still made a profit on it. It just wasn't as big a profit as I would have made had that storage been built.
Okay. Wow. So I was going to ask you something. Hopefully, it's going to leak back into my brain here. So, when you are looking at a market, I mean, typically when we're talking about even a real estate syndication, or even if it's not a syndication, let's say I'm going to go to a different province or state and just purchase a building. I'm going to renovate it. I'm going to, refi it, and then it has to be leased up. Okay, that's what your lease up is. There's the parallels there, but typically a real estate investor can't devote that kind of time. They're going to hire a local property manager like myself if this was up here in Canada. Sounds like you're doing a lot of the lease ups yourself. Is that part of the model? Like, are there, I don't know, self storage property managers to
Yeah.
lease things up
Yes.
for
Third
you?
party property managers.
Sure.
Yes.
Yeah.
Um, so first of all, when I'm looking at a market, there are tools there now, subscription tools that I use to get a quick look in that market. And what I'm looking for is how much product there is already. There's a metric we use in the business, and it's becoming less and less relevant, but it's how, for years, the only real metric we would use is square feet per capita. Like how many people are in that market area, trade area, and what's the current supply. The one thing about storage is, in most cases, you can literally send a drone up in the air and see your customer base. In our portfolio, 86% of our people live 3.2 miles from the facility. So your customer base is right there in most cases, not all cases. Um, you can go online with these subscription services. Basically, they scrape websites, and we can see what pricing is, square foot per capita, average income, household income, and I can get a lot of preliminary data, and I can mostly I look at the pricing, and if there's a lot of discounting going on, I know there's a lot in lease up or it's overbuilt, and so I avoid that. But if I'm in a market where my 10 by 10 non-climates are pushing 80, 90, $100, um, generally I can make those numbers work today on doing an expansion. So I'll start there. Now, if I put something under contract, I always get an independent third party feasibility report that goes into a lot more accurate depth than these subscription services do. And most lenders today in the US require that if I'm bringing new space on. So we will also verify it through an independent third, and we know the supply demand of that market and what the projection for supply demand is going to be in 2029, 5 years from now. And so we go in with those armed with that. And then I do my underwriting and then I adjust my underwriting based on what the feasibility report tells me. So that's how we kind of look for areas and look for markets. Now, one little trick I do and I teach my customers to do. Let's say I'm looking in and I'm making this up. Let's say I'm looking in Pensacola, Florida, and I find a deal in the market, the trade area is awesome, but that deal just won't work. Seller wants too much or it's in poor condition or something. At that point, I will go out in that market and I'll contact brokers and I'll look for empty buildings that I can convert to self-storage. That's usually when I start looking for conversions, is when I find a trade area I really like, but don't can't find any storage there. And rather than build from ground up, I can convert a building. Um, and I've made more money profit on conversions than anything I've done. And it's not that that's I won't do other stuff, but profit wise, I've made more money doing conversions than anything.
Can you define a conversion again, just so we can
So a
break that down?
conversion and I have a YouTube channel with 400 or something episodes, but a couple of them are on urban conversions, and I video the history of a conversion. But a conversion is where you buy an empty building and you convert it from whatever its previous use was to self storage. I particularly like steel buildings 'cause they're easy to cut into and put a lot of glass in, and you want doors show I love doors showing. Doors are like your, the Macy's display window or the Apple box for a phone. So, I like doors showing, and, I especially like buildings that are 16.5 or 17 feet or more because I can put so I can take per square foot income and convert it to cubic foot income.
So you can go higher, put
I
a
can put 2
second
stories in.
story, okay.
Yeah. And it's a beautiful thing when you take square foot income to cubic foot income.
And would you ever buy land, knock down a residential house, try to get it rezoned, that
Done
type
it,
of thing,
done
or
it. I don't like rezoning, but I've done it. In a perfect world, I think I've done them once. I don't like that long process, adds time. Um, but it's done in today, with the third party company we were talking about, we're helping people go through rezoning, and I refer them to a land use attorney, but well, I've helped a number of people go through rezoning.
right,
I just
but
don't like that
it is a slow
process.
process. Yeah, I mean, it's, because you're basically at the mercy of other people for the asset and then the time factor, right?
Yeah, and my experience has been if you're anywhere near we like to be in the mid to up in terms of household income and net worth. And my experience is when you get close to people with some net worth house, they can get really entitled. And it takes a lot sometimes to work it through zoning. And you end up having to do things you wouldn't normally have to do to get buy in from neighbors.
Yeah, for sure. Um, you made a comment earlier, or maybe I read it in your bio, that it's pretty hard breaking in with limited capital. A lot of small investors who are listening to this might feel that self storage is kind of out of their reach without significant capital. What kind of strategies would you counsel them to start with?
Well, I always find out how much capital somebody's working with, and which you do not want to do as a small investor, and I won't do it when I'm consulting or coaching someone, is you don't take all your savings or you don't liquidate your 401k and put it into self-storage. You may take a portion or a significant portion, but you don't take every penny you have and put it in. Um, Today in self storage, probably one of the big benefits that we have today that I didn't have when we got started was SB in the US, SBA lending. SBA, Small Business Administration, basically insures loans to lenders, and they have underwriting guidelines the lenders must use. But you can get in today, you can get an SBA loan with as little as 10% down. Now, the deal's got to work when you're so in other words, if I was buying an existing I'm making these numbers up, but if I bought an existing 25,000 square foot building for, let's say, 1.2 million, and it was going to cost me another 1.2 million to expand it and double its size. What am I, 2.4 in it? When I'm stabilized, I will say it's worth 3.9 million, $4 million. Your debt coverage ratio when you're stabilized needs to be at a 90% loan, 1.25% usually. That just means that your net operating income needs to be 25% more than your loan payment. But so you've got to make sure that those numbers work. And with higher interest rates today, sometimes that can actually get challenging. But an SBA loan, you can get even 10% down, 15% down. So, those are good numbers, and I've used SBA quite a bit I've syndicated deals using SBA loans. So that's one of the big advantages of it. Also, owner financing doesn't typically work, at least for me, a lot in self-storage because I need money. I need cash to do my expansion or my value add play. But very often, if if I can give an owner, let's say 75, 80% of their what they're asking in cash and ask them to hold a 10, 15, 20% second mortgage in a second position with SBA lending, they'll allow that. So there's ways to get around it. But in today's world, you pretty much need to be because of pricing on existing self-storage and construction prices, you pretty well need access to cash. And the cheapest cash in almost every case is the bank cash. My investor cash is usually more.
No, of course it is. Yeah. And then what is the appetite? And I can only speak from multifamily experience in trying to put some syndications together. But typically, you hold a webinar and a bunch of investors are in there, and you're underwriting the deal, and you're kind of showing the demographics of the area, what it looks like, what your as improved numbers are, what the cash on cash return rates would be. What do you find when you're maybe doing these typical types of presentations that the appetite would be for self-storage as a passive investment versus something a little bit more active or traditional like residential real estate?
Actually quite good. Self-storage has become a known product and the advantages of it. The It is the safest asset class for an investor to be in because it has the lowest foreclosure rate of any asset class out there. The risk in self-storage, a few risks. The main risk is lease up. That's when you're the most exposed because you're not stabilized and if I'm at 20% occupancy and the economy shifts or a competitor comes in, that's going to affect me a heck of a lot more than if I'm at 90%. And the other thing is, it used to be considered a weakness, but it's really a plus. Our contracts or leases are month to month, and which means I can raise rates, but rates can also go down. So if I'm in a market, for example, where there's a lot of REITs, street rates can drop. I've seen it as much as 30% in one market. I had one client uh, in a city, major city, rates street rates dropped 30%. Now, in reality, that didn't mean that income went down 30%. Street rates went down 30%. And a lot of banks don't know. You've got to educate some lenders on what that means. Just because they're offering a 10 by 10 at 70, that doesn't mean they're getting $70 for their 10 by 10s. It just means that's the entry point. So nowadays, I have subscription software that can show me averages in a trade area of what the 10 by 10s have averaged over the last 12 months just from scraping websites. And that's a big help. That has helped quite a bit. So, so
Okay.
that it's a safest asset class. Once you're stabilized, I would tell my investors, look, it's pretty boring. I can project
Boring
it.
is good.
Yeah, I act like it's a downside, but it's really an upside to them. But the truth is, and I can historically show them, I can project once I'm stabilized, I can project dang accurately what my cash flow is gonna be 5 years from now, 'cause, there's not many variables hitting the NOI line, or below the NOI line, there's just my loan payment and my reserve payment. So you can project your cash flows very, very accurately. And it's amazing. I mean, I've been within 1, 2%. 8 years later, when I sold it, I projected year eight, and we're within 1, 2% quite often.
Wow. We've been talking about your background and the asset class itself. Before we end, I'd like to give you I'm giving you the last word with the question I ask everybody, but the second last word, why don't you tell us a little bit about how you help people and get into this asset class?
Well, I wrote a book called Creating Wealth Through Self-Storage, and I have a website, creatingwealththroughselfstorage.com. On there is, blog/training. I have a lot of free training, 400 episodes. I have online courses I sell, how to build your first facility, how to buy your first facility. My premier training is what we call the Quick Start Academy Boot Camp. I have a on-demand online version of it. Plus, it's something I usually host once a year, sometimes twice a year. Used to do it in person. Now I do it, virtual like we're doing now. That's a 2-day intense training that's designed to take you from wherever you are now all the way to putting your first self storage facility into service. I have courses on fundraising. Probably the newest company I've created is a company called Resolve. Um, is I sold off my brands, and I'm getting back in, albeit in a smaller way, but I'm doing other projects with uh, friends and people I've worked with over the years. And what I was finding is we used to do our own expansions because, I'm not a builder. I have no construction experience, but it's really not that complicated. Um, Concrete, site work. The steel fabricators create building plans. Anyway, I developed a way of doing it for, let's say, 48 to 52 bucks a foot on expansions. Today, most lenders are requiring a GC, so they wouldn't let me do it today. So as I was getting bids from GCs, what I was building at 50 bucks a foot were coming in 95, 120. And there was just no way these deals would work for me. So I basically created a small construction company first to just handle our stuff. And even today, doing it the way that I've done it in the past, today we're at about 75 bucks a foot. But that's a heck of a lot better than 95 or 120 a foot. So in the my online world that I kind of traffic in, I'm dealing with small investors, and that's also a service we can offer. We can help them get their projects approved and save money there. That's where we saw people were spending way more money than they needed to with architect and engineering, because the fabricators provide a lot of that service that's included in the contract if you sign with them. And so we help them go through that process. And then our only request is we be one of the GCs that bids on it. We're going to give them biddable documents, and then we want to bid on it. And in an open bid situation, we'll usually get it. A, because we've established a relationship, and B, because we charge less money as a GC fee. So now, so that's, I don't really go out into the public with that a whole lot. It's mostly with the people that in my little world, the people I work with. But that's my newest adventure in storage.
Okay. And what do you think the future looks like? I mean, I'll preface that by saying I'm very interested in not only asset classes like this, but I just had a guest on talking about home services because I'm very interested in acquiring businesses in the home service industry because I'm a property management company, HVAC, plumbing, electrical, because I believe they're somewhat AI resistant or even AI proof to a certain extent. They're
Mm.
meaning they're not going to get disrupted to the point that you're going to be put out of business necessarily. Where do you see the future going with self storage and is it AI resistant?
Um, yes, it's AI resistant, and we use AI in it now. It helps us quite a bit on certain things, especially underwriting. Um, so pods, you know about pods, portable pods, that did not disrupt the storage business. Um, concierge storage hasn't disrupted the storage business. I think the storage business has a bright next 10 or 15 years. And here's where I really see the opportunity for small investors. Um, like myself. When I say small, I'm not rolling. I'm not a fun guy with $50
Sure.
million I got to place. I'm a small investor going kind of deal by deal. Um, but 10 years ago, the REITs owned 20% of the storage space. Today, and you know how many big players you see out there, they own 32%. So there's the vast majority of storage is still owned by mom and pops. 58 to 60% are owned by people who just own one. The real opportunity is getting those, bringing them to institutional grade standards, and then there's a lot of consolidation going on in this industry. And over the next decade, my game is to take advantage of that consolidation and create something that REITs would buy. Another exciting thing is boat and RV. When I first got going, it was like, we might have some parking and we use the parking till we wait to expand on it. Today, with the amount of RVs being generated each year, my I could be wrong, but my calculations based on numbers I see are that about each year 18 to 20% more demand for nice Class A boat and RV parking, canopy or enclosed, is generated every year by the RV industry. And so I see we're doing a couple projects that are just basically designed around storing boats and RVs. So I see those as real like opportunities in this space over the next decade. And I'm bullish on it. We're just you're as a small investor, I'm going to be doing fewer deals than I did maybe 8 years ago, simply because of what we've talked about over this podcast.
Wow. Oh, that is great insights, Mark. I love that. Okay, final word. This is the Investing to Win podcast. How do you define success and what does winning look like for you?
Oh, great question. So for me, success, and I teach this with the people I work with, success is the achievement of goals that you've set, the systematic achievement of predetermined goals. Winning is when that success is fulfilling. You can be successful in life and it's very unfulfilling. But if you can be successful and have your success like feed your soul and get you up in the morning, and like I failed at retirement, Garrett. When I sold off those 2 brands, I thought I was gonna sit back and just kinda lull on the beach a little bit, and I absolutely failed at it. I've gotta have a future calling me forward. So I created another 5. I've got goals through the the next 4 years. I created 5-year goals, formed this construction company, and I'm going back out and playing, albeit a different game, but for me, the fulfillment is in playing the game and moving towards predetermined goals. And my personal, what really fulfills me is helping other people. So my game is I don't make a dollar that doesn't help somebody else.
Yeah. No, if you can do all of that and have fun doing it, I mean, what is retirement really, right? That's just sort of a goalpost or a finish or a mid finish line, I guess, yeah, on to the bigger goal, right? I don't know anybody who is truly retired that didn't move on to do something else. That might be maybe financially independent or the ability to choose what you want to do. Maybe that's what retirement is really about in these modern times.
Yeah. Well, I know we got to go. I just want to acknowledge you, Garrett. You have a great podcast. You have such a wide variety of people on here. And as an interviewer, you are a dang good interviewer. You don't ask just the surface questions. You can take answers and then go another level down. So I really acknowledge you for being a great podcast host.
Well, thank you. Thank you, Mark. I appreciate that. Yeah, no, I'm a little too modest, probably a little bit humbled by that, but I do appreciate that. And, it's a skill that I'm learning and trying to get at better at every day and, listening to some other podcasts and my mentors. And I'll continue to strive, but thank you.
You got it. Great being with you.
Okay, take care.